Opening the Monetary Policy Review meeting, Governor Lisicha Kganyago immediately set the tone, with global trade uncertainty the main underpin of discussions.
We meet here today when the world economy is in economic turmoil. The confidence regarding global economic developments we projected in October has largely evaporated. And this has been displaced by heightened economic uncertainty due to trade tensions.
The Reserve Bank's head of research gave the main review presentation, noting that while inflation had been coming down in advanced economies, albeit not to the extent that was targeted, roughly 2%, higher global tariffs were likely to see inflation ratchet up again, also warning of the possibility of stagflation, which speaks to low levels of growth amid higher levels of inflation.
One of the things that combination of circumstances or dynamics does is it creates more volatility in financial markets. And again, this point, harking back to this point about uncertainty, this graph shows you a little bit about what that uncertainty actually looks like when it translates into interest rate expectations in advanced market economies. And the takeaway here is simply that these lines all show what was expected to be interest rate cuts in the UK, which is green, the Eurozone, which is red, and the US, which is in blue. And these have changed a lot over just a 4-month time frame.
Bank says with global economic dynamics as uncertain as they are, it now means central banks' policy rate paths are now less certain, indicating that it looked as though rates would probably stay higher than previously expected for longer. Focusing on South Africa, the Reserve Bank noted that the economy continued to be bedeviled by weak productive capacity.
Sectors had a lot of volatility, driven both by mining and agriculture, but the secondary sector, which is in yellow, has been and remains pretty depressed. Broader demand and supply, both are contributing to this, to a weak investment profile, and that investment profile is pretty critical to growth, as I will show you just now. If you look at this graph, you can see whether it's general government, private sector in blue, or public corporations in red, those real gross fixed capital formation levels remain, again, way too low.
In the question and answer session, concerns were raised around the economic impacts of global tariffs and the implications of South Africa losing access to the African Growth and Opportunity Act, also known as AGOA, which has enabled duty-free access for some of the country's goods for over the past 2 decades. The bank put things into perspective, indicating that about 7.5% of South Africa's total global exports were bound for the United States, adding that of that 7.5%, only 25% of it benefited from AGOA, also noting that it was time to look at the bigger picture.
Obviously, things are changing a lot. I think the important thing here to realize is it's quite a different scenario when the whole world is facing new tariffs. And that impact is going to be considerably bigger than when only South Africa is impacted, because that impacts global demand around the world, and that's going to have a much bigger impact on our outlook and so on. But that's stuff we're still working on. Thanks.
The Reserve Bank noted that if stagflation became a reality, it would make the work of central banks around the world that much more difficult. This, as they work to tame inflation with higher interest rates, they could end up further exacerbating contractions or stagnation in GDP levels. Nompumelelo Siziba, SABC News, Johannesburg.